Hi, everybody. Welcome back to Ox Talks. It is Wednesday, February 21st, 2024. Hope all of you are having a productive day today. A lot of things to cover. Before I start, I want to say thank you for subscribing to this channel. If you haven't subscribed and you are watching the videos, I would humbly ask that you please hit the subscribe button. Please continue to hit the thumbs up on the videos and also the bell notification. Continue to leave your comments. I do appreciate and read the comments and do my best to respond to as many of them as I possibly can. Most importantly, as we always discuss, please continue to share these videos with your family, your friends, coworkers, colleagues, anybody who will listen to the message and have an open ear and open eyes as to what is unfolding. We're going to share some more stories, economic-based items today that continue to pile on and continue to explain how badly this economy is going. Let's jump right into it. The first article I saw today is entitled "Supermarket Scramble. Food Spending's Share of Disposable Income Hits Highest Level in," get this, 3 decades. This is out of the Zero Hedge earlier today. It says the most recent inflation prints, we know CPI and PPI, are the latest examples of the failing economics for most Americans. It says for many, the supermarket is a painful experience as prices for everyday necessities remain elevated while real wages are negative once again. The risk of inflation reaccelerating is even more terrible news for the consumers ahead of spring. The article says that they had penned an article previously in the month titled "Food Inflation is Not Dead Yet," as commodity prices for cocoa beans, ground beef, Robusta coffee, and orange juice had been on the rise, among other items. This is a startling new report from the Wall Street Journal. Shows consumers spent 11.3% of their disposable income on food, the highest level since the early 1990s. So we talk a lot of these articles. We were going back and comparing data from the dot-com era in the early 2000s, from the Great Financial Crisis time frame in 2007, 8, and 9. Now we're talking about having to go back 3 decades to a point when Americans spent this much of their disposable income just to put food on the table for their families. So let me ask you this. Do you believe this is going in the right direction? I titled the video, "These Things Are Continuing to Go Up, and we all need to be ready for a reason." We're talking about food prices now, and we're going to get to the interest rates and the mortgage rates in a couple minutes. The article continues, quote, "If you look historically after periods of inflation, there's really no period you could point to where food prices go back down," said Steve Cahalan, Chief Executive of snack giant Kellanova, in an interview warning food prices tend to be sticky, meaning even if the Fed is successful, I don't know how you would measure that, but successful in getting inflation under control, which it hasn't yet. What this article is saying is food prices are not necessarily going to come down along with the reduction in the pace or rate of inflation. So buckle up, get ready. How can you, let's say, buffer this now? Well, one thing you could do, and we discussed, is try your best to have some reserves on the side. Have some cash reserves, have some money saved up so that you can meet these additional cost obligations as they arise. The next thing you could do is consider stocking up on certain items that are a certain level of cost now. Maybe when you go to the store, buy a couple extra cans of that food, or buy a couple extra pieces of meat and throw it in the freezer. Buy some extra frozen vegetables and keep them in the freezer. Those are the kind of things that you could do if you believe that food prices are going to continue to go up. If you buy some extra stuff now, it's there. If the food prices don't go up, you're going to use it anyway. So I don't see any downside to maybe stacking some additional foodstuffs, some additional supplies, meats, vegetables, things of that nature now, if you have the extra ability and extra income to do it. For many, I understand that's not realistic. We're already all spending evidently a substantial over 10% of our disposable income on food. And for some families, it's even more. My sister has 5 kids, so I guarantee they're spending more than that of their disposable income on feeding the family. So depending on the size of your family, I know, and also depending on whether you've been laid off recently, whether you've had some other economic challenges, it is much worse for many across this country. It says what this guy means is that consumers should get used to spending a higher percentage of disposable personal income on food. We just talked about that in a couple ways that you could try to buffer it. Inflation may have slowed down, but shrinkflation is in full force. It says get used to paying higher prices and receiving less. We've covered the shrinkflation issue as well on prior videos. You can tune in and take a look at that. Shrinkflation is alive and well, as most of you, I'm sure, have experienced at the supermarket. The next article deals with probably today's biggest story that came out was the FOMC meeting minutes from the January meeting were released today. Again, these are in hindsight that they published these minutes, and what it says, what the article is entitled, "The minutes show most officials fear risk of cutting too quickly." So again, pushing back against the narrative that's being pumped out there on all the mainstream channels and in the stock market that the Fed is done raising rates, that they're going to be embarking on a rate cutting cycle soon. The article says the Fed is worried about cutting too soon more than waiting too long. Quote, most participants noted the risks of moving too quickly to ease the stance of policy and emphasized the importance of carefully assessing incoming data in judging whether inflation is moving down sustainably to 2%. So reading between the lines, it hasn't moved down sustainably if you even believe the government's inflation numbers. If you go look at John Williams at Shadow Stats, his numbers put inflation at a much greater level. It says, quote, several participants mentioned the risk that financial conditions were or could become less restrictive than appropriate, which could add undue momentum to aggregate demand and cause progress on inflation to stall. Meaning they want to slow the economy. If they start to cut rates, that's going to cause everything to inflate again. Everybody to go out and extend and borrow more and take on more credit, and that's going to have the opposite effect of the intended consequence. So what they want to do is they want to continue to squeeze this economy, keep the pedal down, from my perspective, to shock this into a meaningful change, which is, again, against the narrative that you're hearing on the mainstream media. So get used to, from my perspective, rates higher and for longer. So since the last, and this is interesting, the CPI numbers and the PPI numbers were released in February after the Fed's last meeting. So this is talking about their belief at that time. Since then, we know CPI came out hot, PPI came out hot, blew out expectations, and it says the last FOMC meeting on January 31st says Bitcoin's been an outstanding performer. It has. It's a little off topic, but I've seen the cryptos going up. I think it's pulled back a bit. But this was, again, if they were worried then, what do you think their behind the doors, their true position is now? It says rate cut expectations have plummeted Since the last FOMC meeting, which with March cuts now off the table, we know that, and 2024 total cuts down from 6 to a 50-50 call between 3 and 4 cuts. And I wouldn't be surprised if you don't even see that. All eyes will be on the minutes for an explanation of why they pushed back against a March cut. But as a reminder, we just discussed this, all the ugly data, hot NFP, hot CPI, hot PPI, came in after these minutes. Quote, many participants indicated that they expected core non-housing services inflation to gradually decline further as the labor market continued to move into better balance and wage growth moderated further, meaning wages were down. Various participants, again, that's the goal. They want to crush the economy. They want to crush the consumers. They want they want more layoffs. They want wages to shrink. They want the work week, number of hours being worked per week to shrink, and we know that's happening. Various participants noted that housing services inflation was likely to fall further as the deceleration in rents on new leases continued to pass through to measures of such inflation. And that didn't happen. So their expectations as of these minutes, we know that when the CPI, PPI numbers came out, the rent inflation was up, not down. So this is not supportive of easing rates. The staff outlook had some notable highlights. Staff placed some weight on chance that further progress on lowering inflation could take longer than expected, and staff forecast risk to economic forecast skewed to the downside, meaning the bottom is going to continue to fall out of this economy. In the last few minutes, Fed Governor Michelle Bowman says that the current economic environment doesn't warrant the central bank cutting rates. Quote, certainly not now. So buckle up. We are going to see higher for longer. What is this going to do? Higher rates, where does that put the most amount of pressure in this economy on the consumers? I'll tell you in two places. One is credit card rates, and the other is mortgage rates. There's an article that came out today at CNBC that ties into this mortgage rate issue. And it says mortgage demand takes a massive hit as interest rates cross back over 7%. We addressed this last week on a show as well, but the rates continue to go up on mortgages, which is going to further force people on the sidelines from buying a home. It's going to further constrict supply, and we're going to see more of the same with regard to this housing issue. It says mortgage interest rates surged last week to the highest level since early December, and that hit mortgage demand hard. Total application volume plunged, listen to this, 10.6% compared with the previous week, according to the Mortgage Bankers Association seasonally adjusted index. The average contract interest rate for a 30-year fixed-rate mortgage with conforming loan balances, and that's $766,550 or less, increased to 7.06% from 6.87%, with points rising to 0.66 from 0.65, including the origination fee for a loan with a 20% down payment. So this is if you have 20% down, and if you have a credit score of probably 760 or higher. If you're buying $1 million home, 20% down, you better have $200,000. You're going to have $200,000 of cash coming to the table in order to get that rate. If you're buying a $500,000 home, it's half that. Still a substantial down payment. The less down payments you have, the weaker your credit score is, the higher the rate you're paying. Says mortgage rates moved back above 7% last week following news that inflation picked up in January. Again, the CPI report we just talked about, dimming hopes of a near-term rate cut, said Mike Frattoni, the MBA's chief economist, in a release. Applications to refinance, listen to this, refinance a home dropped 11% compared with the previous week, and were just 0.1% higher than the same week a year ago. 1 year ago, the 30-year fixed rate was 6.62. Refinance volume had been running above year-ago levels, even with rates higher this year, but the jump in rates last week clearly made a refinance not worth it for most borrowers. You understand that what you have equity in your home is even not your money. Yes, you can put it on a balance sheet as an asset, but if you want to pull that equity out of your home, you have to do it by way of a refinance or a home equity line of credit. And you have to qualify for those loans just as if you were qualifying for any other kind of a mortgage. And you're going to be paying these high interest rates to pull your own money out of your so-called own, something that you so-called own as your home. So it is a challenge. People have been relying on their homes as piggy banks for a long time. A lot of people who have discussed sharing these articles in the past with you on this channel have tapped out their home equity line of credit loans. Now those are having to be repaid at higher rates. Application for a mortgage to purchase a home fell 10% for the week and were 13% lower, it says, than the same week a year ago. They sat at the lowest level since early November of 2023. And listen to this. This is something you want to pay attention to. With rates higher, the adjustable rate mortgage share of activity increased to 7.4% of total applications. ARMs, adjustable rate mortgages, offer lower interest rates but are considered more risky because they can adjust higher after a fixed period. If you go back in 2006, 2007, that was one of the problems with those adjustable rate mortgages. Not only did they adjust higher as rates went higher, but people's equity in their homes was dropping. And so they had a double whammy, higher rates to deal with and falling equity prices. That will be here again, I guarantee it. So that's what's happening. We have food prices up. We have interest rates are going to stay up. We have mortgage rates higher. Those three things are a recipe for disaster. Let me address one more article just because I raised this on a show a few days ago about the trucker boycott in New York City. Something came out today. You can interpret it however you want. Is it disturbing to you or not? Feel free to leave comments below. And this is out of the Zero Hedge, and it says, quote, I'm just going to read the title of the article. No one's got to me. I ain't scared of SHIT. New York City trucker boycott leader Chicago Ray steps down. That's the title of the article. It says Chicago Ray, the trucker who ignited the righteous anger of his fellow truckers and of millions of other Americans, has stepped down from his boycott leadership. It says, does that mean the end of the trucker boycott of New York City? Now, according to Trucker Ray, at least in this article that's summarizing what happened, he says he took his video down, and I guess it had millions of views, and he says he took down the video or the post because it went viral and his grandson had seen it on TikTok. You can interpret that as to whether you believe that or not. That's what he's saying happened. He says, he says, quote, I'm not leading, nor have I encouraged, or am I encouraging anyone to do anything other than what they were doing prior to the ruling on Friday in New York City and the ruling in the trial that we discussed on that video. So look, I felt obligated to, I'm not going to weigh in on this from the political perspective or what you think happened or didn't happen. I think we all can read between the lines, but I wanted to put that in today's video because it was, again, something I addressed in a video a few days ago. And I always tell you, I will keep you up to date, informed on stories that I've talked about in the past, that there are changes or updates or any additional information. So that is what's happening. We'll see if the cause continues or not. Went a bit long today, but I shortcutted you guys yesterday because I had a lot to do. I had to keep it short yesterday. Let me address briefly before we finish up. Leaving here in about an hour to get my workout in. Today's a 1-hour shoulder workout for me. Love Wednesdays, love shoulder workouts. Please get your steps in. Move. Don't get sedentary. If you're in an office job, I'm in this chair a lot during the day. I force myself to get up, jump on a small treadmill I have here in the office for half an hour. Please keep walking. Do some cardio each day for circulation and for mobility. Please get some strength training in, push-ups, sit-ups, squats, body weight squats. You can grab some weight. You can grab a dictionary or a heavy book or anything you have as well. And you can also use that when you do your body weight squats if you want to increase your capacity. The diet's super important. Please don't disregard that. Please don't neglect the diet. You could be exercising every day for 2 hours a day, intense exercise. And if you go home in the evening and you eat a junk diet and you shovel down a bunch of chips and cookies and stuff that's bad for you, fried foods, you're going to not only see no results, but you're going to take a step back and many steps back. So please keep that in mind. With that being said, hope all of you have a terrific evening, and I'll see all of you tomorrow. Bye.